peak tightening has been reached. So we think that the ECB is done with interest rates. So the terminal rate has been reached. And as you said, now the focus is when the ECB is going to cut rate. Well, data has surprised on the downside. So we could argue for a rate cut happening earlier than expected. If we look at activity data, clearly the data have been soft, contraction in Q1 with the Eurozone economy flirting with recession since the end of 2022. And we also had positive news on inflation easing to 2.4% and even core inflation easing to 3.6%. And more importantly, if you look at the momentum of core inflation, it has declined quite substantially. So just looking at those data play in favor of the ECB cutting rate earlier than expected. However, this is not what we have in mind. We expect major central bank, not only the ECB, also the Fed, to cut rate in the second half of next year, notably because we have the growth momentum changing direction with a recovery, notably in the second half of next year, and the risk that inflation might be more persistent than expected.
Sabrina, good morning. I love this view because it's unconsensus at the moment, particularly around Europe, where everyone's very negative. I'm not sure I agree with you, but I still love it. So the growth in Europe is obviously getting much more negative, and we are seeing that kind of disinflation impact. And I understand it's going to be sticky, but in an economy where that's clearly slowing, the idea of keeping yields very high when we've got this disinflationary impact means you're going to have widening real yields into a slowing economy. Are you not quite worried that risks a much more severe downturn before the ECB acts?
Yes, indeed, that's a very good point. But at the same time, we can see that the Eurozone economy has clearly weakened on the back of the effective transmission of the monetary policy, which has been amplified by the war in Ukraine. So as said before, if you look at the evolution of the economic activity since the end of last year, it's really weak. But now we have early signs that the economic activity could do better in 2024, just looking at sentiment, which has stabilized at low level with signs of a gradual recovery in 2024. Also, if we look at monetary indicators with credit growth, which remains in negative territory, it has contracted at a weaker pace. If we look at credit impulse, it has reached a trough in line with the ECB bank lending survey pointing to a peak in tightening condition. So from there, indeed, economy remains pretty weak, but there are some room for improvement, and notably an economy that could be driven by private consumption, mostly reflecting weaker inflation, but at the same time rising labor income with positive real wages, providing some support for consumers next year.